Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host, and today we're examining a strategy called Cci Trend Pullback. This is a trend-following approach that pairs two exponential moving averages with the Commodity Channel Index, or CCI, to time entries into short pullbacks within a larger trend. Over the next few minutes, you'll learn exactly how it defines a trend, how it waits for a pullback, and how it frames its protective stop and profit objective. Remember, this video is educational only, not financial advice. Let's dive in. So what exactly is the Cci Trend Pullback Expert Advisor? At its core, it's a trend-following pullback system. Rather than trying to predict tops and bottoms, it aims to join an existing trend after a short, healthy pause, buying a temporary dip inside an uptrend, or selling a temporary bounce inside a downtrend. Two independent, objective components drive the whole system. The first is a pair of exponential moving averages that define the trend direction. The second is the Commodity Channel Index, a momentum oscillator that measures how far price has stretched away from its average. By combining a trend filter with a pullback gate, the strategy tries to enter in the direction of momentum while avoiding the temptation of chasing an already extended move. Because it reads only closing prices, standard indicators, and the average true range for stop and target placement, it's symbol and timeframe agnostic. The built-in notes suggest it's well suited to liquid foreign exchange pairs such as euro to US dollar or pound sterling to US dollar, or to gold, on timeframes between 15 minutes and 1 hour. That said, nothing here is a recommendation. Every market and timeframe behaves differently and should be studied on its own. Who is this style of strategy for, in an educational sense? It tends to appeal to traders who prefer a rules-based, patient approach, people who are comfortable waiting for several conditions to align rather than acting on every wiggle. It only takes one position at a time per magic number, and it defines its own exit through a protective stop, a profit objective, and a trend flip safeguard. Throughout this video, keep in mind that we're studying how the code behaves, not predicting what it will earn. Markets carry real risk, and every strategy experiences losing trades. Our goal here is understanding, not expectation. Let's break down the mechanics step by step. The Cci Trend Pullback strategy works on a single time frame and acts only once per completed candle, so every decision is based on closed, confirmed data rather than a flickering live price. The first building block is the trend filter. The EA calculates two exponential moving averages of the closing price, a fast one, defaulting to 20 periods, and a slow one, defaulting to 50. When the fast EMA sits above the slow EMA, the strategy considers the market to be in an uptrend and will only look for buys. When the fast EMA is below the slow EMA, it treats the market as a downtrend and looks only for sells. This keeps every trade aligned with the prevailing drift, so the system never fights the larger direction. The second building block is the CCI pullback gate. The Commodity Channel Index is built from the typical price, the average of each candle's high, low, and close, and it measures how far price has stretched from its recent mean. The default CCI period is 20 and the extreme threshold is 100. Inside an established uptrend, the EA waits for the CCI to dip down to or below -100, signaling a pullback against the trend. It still does not buy. It waits for the very next reading to climb back above -100, which shows momentum turning back in the trend's direction. A final filter requires the signal candle to close higher than it opened, confirming buyers are back in control. The short side is the exact mirror. In a downtrend, the EA waits for the CCI to push up to or above +100, then roll back below it, with a bearish candle closing lower than it opened to confirm. Risk framing comes from the average true range, or ATR, using a default period of 14. For a long trade, the protective stop is placed 1.5 ATR below the entry price, and the profit objective 2.5 ATR above it. For a short, the stop sits 1.5 ATR above entry, and the objective 2.5 ATR below. That fixed relationship gives a reward to risk of roughly 1.67 to 1 on every trade. Finally, the strategy manages one position at a time per magic number, and it includes an extra exit. If the trend filter flips against an open trade, for example, the EMAs cross down while a buy is live, the EA closes that position early rather than waiting for the stop. Trading always involves risk, and losses are a normal part of any approach. Let's look at the actual MQL5 code that runs inside MetaTrader 5. At the top are the input parameters you can adjust in the EA's settings. FastEma and SlowEma set the two moving average periods, defaulting to 20 and 50. CciPeriod and CciThreshold control the oscillator, defaulting to 20 and 100. ATR-period sets the volatility lookback at 14, while AtrSlMult and AtrTpMult 1.5 and 2.5 scale the stop and the profit objective. Lots fixes the trade size, and magic tags the EA's own orders. Now to the heart of the strategy. The long signal is a single Boolean line. It's true only when uptrend is true. The previous CCI reading was at or below negative CciThreshold. The current reading has climbed back above it, and bull candle confirms a higher close. When all four align, the code reads the ask price, sets the stop 1.5 ATR below it, and the take profit 2.5 ATR above it, then calls trade.buy with the fixed lot size and those levels. The short signal is the mirror image. It's true only when downtrend is true. The previous CCI reading was at or above positive CciThreshold. The current reading has dropped back below it, and bear candle confirms a lower close. When those line up, the code reads the bid price, sets the stop 1.5 ATR above and the take profit 2.5 ATR below, and calls trade.sell. Notice how compact and symmetrical this is. Both entries share the same three-filter logic: trend, CCI extreme and recovery, and a confirming candle, and both use the same ATR-based framing for their stop and target. That symmetry is what makes the strategy easy to reason about. Let's bring the logic to life on a chart. Up top, you can see the price candles with two moving averages drawn over them, the faster 20-period EMA and the slower 50-period EMA. Below the price, in its own panel, sits the commodity channel index, with dashed reference lines at positive 100 and negative 100 marking the extremes the strategy watches for. On the far left, notice how the fast EMA is riding above the slow EMA. That single relationship is the strategy's entire definition of an uptrend, and while it holds, the EA will only consider buys. The first two candles push higher and the CCI climbs with them, confirming healthy upward momentum. Then the market takes a breather. The third and fourth candles pull back, price slips lower, and the CCI slides down through the negative 100 line into its lower extreme. This is the pullback the strategy is patiently waiting for, a temporary dip against an uptrend that often shakes out weaker positions. Importantly, the EA does not buy here. Diving in while the CCI is still stretched to the downside would mean entering a market that is still dropping. Instead, it waits for confirmation. On the next candle, the buyers step back in. Price closes higher than it opened, a bullish candle, and the CCI snaps back up through the negative 100 line. Now every condition lines up. The trend is up. The CCI reached its lower extreme on the prior bar and has recovered, and the candle body confirms momentum returning. The buy entry marker prints right here. At the same moment, the EA measures recent volatility with the ATR and places a protective stop 1.5 times that ATR below the entry, with a profit objective 2.5 times ATR above it, a reward to risk of roughly 1.67 to 1. From there, the trend reasserts itself. The following candles climb higher. The CCI recovers back toward its upper extreme, and price reaches the take-profit level. The long trade closes at its profit objective, exactly as the framing intended. Now watch the character of the market change. Price rolls over, and a few candles later the fast EMA crosses below the slow EMA. The trend definition has flipped to down, so the EA now sets aside buys and looks only for short opportunities. History repeats itself, but in mirror image. Within this new downtrend, price stages a countertrend bounce. Those rising candles lift the CCI up and through the positive 100 line into its upper extreme. Again, the strategy stays patient. A bounce inside a downtrend is exactly the kind of move that traps late buyers, and entering while the CCI is still elevated would mean chasing. Then the confirmation arrives. The next candle closes lower than it opened, a bearish candle, and the CCI rolls back down through the positive 100 line. The three filters agree once more. The trend is down, the CCI tagged its upper extreme and turned, and the candle body confirms sellers taking control. The sell entry marker appears. The stop is placed 1.5 times ATR above the entry, and the profit objective sits 2.5 times ATR below. Price then continues lower, candle after candle, the CCI sliding toward its lower extreme, until the market reaches the short take-profit level and the trade is closed. Notice the symmetry across both trades. The trend filter set the direction, the CCI extreme identified an exhausted pullback, and the confirming candle told the strategy that momentum was resuming before it committed. That combination, trend, pullback, and confirmation, is the heart of Cci Trend Pullback. That brings us to the end of our walkthrough of the Cci Trend Pullback Expert Advisor. We covered how it uses two exponential moving averages to define the trend, how the commodity channel index identifies a pullback and its snapback, how a confirming candle filters out weak signals, and how the average true range frames the stop and the profit objective on both the long and short side. If you found this breakdown helpful, please give the video a like, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss future MT5 strategy studies. You can find more resources over at www.algobot.live. As always, this content is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Trade responsibly.